Question number 6. The balance sheet of Y Limited as on 31st March 2024 was as follows. With the balance sheet, we have been given 5 schedules. So I have listed all these things here. And adjustments. Preference dividend is an arrear for last 3 years. Given in the adjustment, if later on this arrear is waived, then you no need to consider that at all. No entry. But instead of that, if it is considered being the liability, then it's a loss charged to the capital reduction account. What are the things are there? The loss, almost 11 adjustments are there. Past journal entries for all the above mentioned transactions, including amounts to be written off of goodwill, loss and profit or loss, and discount on issue of debentures, all the 3. So these are fictitious and intangible assets not required to be usually written off, whether stated or not. Prepare bank account. So you better prepare the bank account. There may be some transactions related to the bank receipts and payment. It's better to prepare that one. Working of allocation of interest and debentures between A and B. What does it mean? We'll see now. A holds 10% first debentures. Okay. A holds 10% first debenture. 4 lakhs. 10% second debenture for rupees 6 lakhs. He is also creditor for rupees 1 lakh. Apart from that, A being the creditors of the company, for which company has to pay 1 lakh to him. B holds first debentures for rupees 2 lakhs. And 10% second debentures 4 lakhs. Also is being the creditor for 50,000 rupees. So A and B are the contributors by way of first debenture, second debenture, and creditors apart. The following scheme of reconstruction has been agreed upon and duly approved by the court. All the equity shares be converted into fully paid up equity shares of rupees 5 each. Number 1. So let's finish up that one first of all. So 10 rupees equity share is going to be converted into 5 rupees equity shares. I'll finish up the journal entry for this one here. Okay. 10 rupees equity share capital account debit to 5 rupees equity share capital. Original value being 50 lakhs. Now it is only 25 lakhs. The difference between these two is the capital reduction 25 lakhs. Second, the preference shares are to be reduced to 50 each, and then the preference shareholders agreed to forego their arrears to preference dividend, in consideration of which 9% preference shares are to be converted into 10% preference shares. So out of the 100 rupees preference shares, now they will be getting only 50 rupees preference shares, another 50 rupees capital reduction. And also there is a arrear of dividend for the last 3 years. What about the scenario for that? Of course, they are willing to waiver that also, provided hereafter that preference dividend should not be 9, it should be 10%. So 9 is converted into 10 in order to forego this one. Anyhow, increasing from 9 to 10, there will not be any profit or loss currently. Forget about that. But 100 rupees preference share is converted into 50 rupees. Then difference between these two, 50 rupees is your gain. Can go to the capital reduction account. Here, second one. 9% preference share capital of rupees 100 each, value being 20 lakhs, converted into 10% preference share capital of rupees 50 each, 10 lakhs. The difference between these two is the gain transferred to the capital reduction. 20 lakhs preference share is converted into 10 lakhs preference share, so gain is there. Of course, 3 years preference dividend is in outstanding. So now what happened? So we don't want to get that also. We never bother about that. We will be willing to waiver that, provided at least hereafter you give me the preference dividend the rate of 10% rather than 9%. Okay. Already this preference dividend is in arrear given outside balance sheet and also not required to be payable. So no entry at all. Third one. Mr. A is to cancel 6 lakhs of his total debt, including interest on debenture, and pay 1 lakh to the company and receive 12% debentures for the balance amount. So what happened? Cancellation will be 6 lakhs of his total debt, including interest on debenture. So you have to find out the interest on debenture also. So let's see. Already we have studied here. Okay. Working of allocation of interest on debenture between A and B. We have this duty also to be done. Okay. I'll just pick this one here. 4 plus 2, 6 lakhs. Naturally, it carries interest rupees 60, 10% rate. This one carries 1 lakh. The overall 1 lakh 60 being this debenture interest outstanding. In this, it should be allocated for A and B. Should be allocated for A and B. As the first debenture held by A and B being in the ratio of 4:2, okay, the same ratio, 2:1 ratio, this can be allocated. For A, it is 10 and for B, 20. And in case of second debenture, it is again 6 lakhs, 4 lakhs, otherwise 3:2 ratio, or for 10 lakhs, 6 lakhs, 10%, 60,000 for A, and for 4 lakhs, 10%, 40,000 for B. So for A, it is now 1 lakh, for B, it is now 60,000. Is that clear? This 160 is segregated. So interest on debenture, which is available as outstanding, appear as outstanding in the balance sheet liability side being 160, out of which 1 lakh is for A and 60,000 is for B. 60,000 is for B. Clear? This one is over. Apart from that, A has to give us cash 1 lakh. Okay. The total amount A contributed being 13 lakhs. Am I right? Isn't it? So, Mr. A is to cancel 6 lakhs of his total debt, including interest on debenture. First debenture, second debenture, creditors. If I add interest on debentures with that, so overall 12 lakhs. Apart from that, and to pay 1 lakh to the company, A will give another 1 lakh rupees for the ready operations, immediate operations for the business. So overall 13 lakhs. And to receive 12% debentures for the balance amount. Here he forgoes almost 6 lakhs. To the extent of his liability is forgone will be the gain transferred to the CR. Balance 7 lakhs will be paid off by way of new 12% first debenture. 12% debenture. Nothing stated whether it's the first or second. This is what about the A scenario. Similarly, for fourth one, Mr. B is to cancel 3 lakhs of his total debt, including interest on debenture. He has not given any money. Overall amount recoverable payable to B being 2 plus 4 plus 50 and 60, 7 lakhs 10,000. Out of 7 lakhs 10,000, he is willing to forego 3 lakhs. After foregoing of this value, for the balance 4 lakhs 10,000, company gave him 12% debentures. Okay. Trade creditors other than A and B agreed to forego 50% of their claim. Trade creditors. Now, what about the trade creditors? We have 5 lakhs. 5 lakhs is the trade creditors in total, where 1 lakh and 50,000, 3 lakhs 50,000 will be outside creditors. 1 plus 5, 1.5 lakhs. 1 plus 5, 1.5 lakhs. And interest on debenture 1.6 lakhs. We collect cash bank 1 lakh. To creditors, sorry, to capital reserve, to 12 percentage debentures. 12 percentage debentures being 7 plus 4.10, 11.1 lakh. Right. Capital reserve being 6 plus 3, 9. Of course, you can add this one also, then 10.75. 10.75. If I add this, then it should be added here, 1.5 plus 1.75. Creditors cancelled by how much? 3.25. You can pass a combined entry or separate entry. No problem here. Is that clear? You pass the entry for A and B separately, and to the extent of creditors forgone, also you can pass another entry. So 2 entries can be passed, but I have clubbed both the entries here. So with that, all the 5 entries were adjusted. 5 transactions were completed. Clear? I'll keep it here. Then directors to accept settlement of their loans as to 60% thereof by allotment of equity shares and balance being waived. For the directors, they have given the loan to the company. Out of that, 60% will be settled by way of equity shares. Balance will be the capital reduction. 40% will be the capital reduction. Okay. Directors loan. This value. The entry being directors loan account debit. Loan account debit to equity share capital. The new equity share capital being 5 rupees worth. So 5 rupees equity share capital. 1 lakh, 0.6 lakhs. Difference between these two, 0.4 lakhs being the loss. Or waiver. Waiver will be credited in the CR account. This page is over. Now let's go for this. There were capital commitments totaling 3 lakhs. These contracts are to be cancelled on payment of 5% of the contract price as a penalty. We have entered into a capital commitment. Capital commitment is nothing but we commit ourselves to go for a large projects. Either it may be commitment given from our side or his side, whatever it may be. A enters into an agreement with B to construct a plant and machinery or a factory. While they do for processing to construct, is that okay? While doing processing, okay, there may be sometimes what happens. There may be, in the case of emergency, they can cancel. If they cancel, the other party says, because of your commitment only, I worked so long, now you simply cancel. So A approaches B to construct a factory. As for his requirement, B started working. He gave the plan and he did all the first level work. Suddenly, after 2 or 3 months later, A says, I don't want. And B will be totally panicked. Sir, there's a huge loss. I worked for 2 to 3 months. So, in that case, when there is a contract, it is not completed, but commitment is there to give it. But if I cancel, there will be a penalty. Here, there's a penalty of 5%. This penalty is supposed to pay always loss. Always loss. Paid means it will go out of the cash. Payable means it may be outstanding, as you think. Penalty payable. Okay. Penalty payable. Okay. So, penalty payable is loss. CR account debit to penalty. Penalty payable account. Or simply CR account debit to bank if it is paid. Okay. How it is worked in the text? As payment or pending. That's your choice only. Yeah. In the text decision, payment is completed. For the 3 lakhs rupees, 5% being 15,000. So 15,000 will be there. 0.15 lakhs. The directors refund 1,10,000 of the fees previously received by them. Okay. Now what is the journal entry? The business is getting collapsed, not functioning properly, faces huge loss because of the director's administration. Huh? Immediately, if we criticize the directors, what do you administrate? So we face loss. Company is supposed to be bank reconstruction expenses 0.1 lakh. 0.1 lakh. The taxation liability of the company is settled at 80,000 rupees and the same is paid immediately. Now check what is the provision for taxation we have 1 lakh. Out of that 1 lakh, immediately you are going to make 80,000 payment, balance 20 is waived. So on verification, the tax liability is only 80. Then the entry being provision for taxation, account debit 1 lakh, to bank the payment made being 0.8 lakhs, and to what? Capital reduction account 0.2 lakhs. 0.2 lakhs. Then the assets are revalued as entered. The assets are revalued as entered. Now let's see. Okay. I'll keep all these things in single page. And this entry. This entry. I have passed all the entries except the last one. Except the last one. Clear? What's that? Adjustments related to the assets and liabilities. Yeah. Yes, this one. One after one. Land and building 28 lakhs. 2 lakhs reduction. Loss. So 2 land and building. 2 lakhs. Plant and machinery 4 lakhs. 6 lakhs loss. This is the new asset, new value, I think, right? Revalued as entered. This is what about the new value. Compare with the old value, find out whether there is any profit or loss. Stock 7 lakhs. So 3 lakhs is going to be lost. Debtors 3 lakhs. 2 lakhs is loss. Computers 1,80,000. Then 1.2 lakhs being the loss to computer. 1.2 lakhs is loss. Furniture fixtures 1 lakh. 1 lakh. Trade investment 1 lakh loss. New one is 4 lakhs. We lose 1 lakh. Apart from that, goodwill should be cancelled. 10 lakhs. Discount on issue of debentures cancelled 1 lakh. Profit and loss cancelled 15 lakhs. Patent should also be not worth usually. We'll check if any statement given regarding that or not. As such, now we have completed all these things. Let's cross verify if there is anything missed. Do we have any information regarding patent? Above mentioned including amounts, all these things are okay. Written off of goodwill, loss and profit and loss, discount. So we have completed 3. Find out if there is any balance in the CR. In that case, you can use the CR for writing off any intangible assets, including patent. Otherwise, leave it as you wish. There will not be any problem here in that case. Okay, you will not get any negative mark in this. Now, come on, tell me what is the amount to be charged to the capital reduction account here? Hmm? 44 point. Because of this reason, goodwill becomes 0, discount on debtors, discount on issue of debentures as well as profit and loss becomes 0, and patent remains as it is. Right. Now, come on. Prepare the CR. Otherwise, I prepare separately in the other page. I need space, so I'll prepare the other page. Okay. Now, CR account, of course, not required, but that gives you confidence whether is there any missing or not. That's why I requested to prepare that one. Capital reduction account. Apart from that, you are asked to prepare bank account also. So I'll open these two. All the journal entries are assembled here. I just grouped everything here. So from this, I can easily finish off posting the rest. Here is CR. Equity share capital, the value being 25 lakhs. And here is preference share capital. Because of this reason, I get 10 lakhs. Here is, I have to change this to bank. I change this to bank. Settlement link. Right. Bank. In brackets, you can consider this being penalty paid for cancellation of capital commitment, 0.15 lakhs. 0.15 lakhs. In bank, it's payment, right? So by capital reduction for penalty payment, 0.15 lakhs. In bank, 2 CR, we got director's remuneration or fees back. And in CR, it's a gain, bank, director's remuneration. Director's remuneration, okay. The value being 1.1 lakh. In CR2 bank, for reconstruction expenses, 0.1. In bank, there's a payment for this, for reconstruction expenses, 10,000 rupees. 10,000 rupees. And bank, to 12% debentures, the value being 1 lakh. In this, first debenture, creditors, etc., 10.75 lakhs. 10.75 lakhs. Here is by director's loan. By director's loan. As they waive the loan, it's gain to the organization. Here is provision for taxation. They have waived this, so we gain this much, 0.2 lakhs. In CR, assets, goodwill, discount, and accumulated profits and losses, all together 42.2 lakhs. Come on, tally the CR account and tell me whether it is tallying or not. Huh? 47.45. So there is a balance. How much balance is there? How much balance is there? 5 lakhs. So you can now use it for any other intangible assets we have. Naturally, you can give the note. it is presumed the patent is worthless. So I consider the capital reduction can be used for writing down that one also. So that is another 5 lakhs. Here to patent, the value be 5 lakhs. This becomes 47.2 lakhs. Is that clear? So here to patent, I change this. Here 42.2 lakhs. 47.2 lakhs. Then naturally, patent also now 0. Patent also now 0. Is that clear? Now finish up telling the bank. 2.1, 2.1, you get 1.85, am I right? 1.85 lakhs balance you have in bank. 1.85 lakhs. Now, I have to adjust with the bank balance already. Already we have bank overdraft here, 1 lakh. We don't have the bank balance, but we have bank overdraft. Then we can use this bank overdraft here. Overdraft should be in the credit side, 1 lakh. Then naturally final balance is only 0.85 lakhs. And we have paid the provision for taxation. I missed to record this one. So here bank. So taxation. Okay. Tax paid, which is 0.8 lakhs. The balance cash being only 0.05. 0.05 lakhs. Otherwise 5,000 rupees you have cash. 5,000 rupees you have cash. Now what happens? So we have prepared CR and found it is agreeing. Bank balance we have 5,000. I have to show that here. In current account, we need to introduce one new account called bank. Bank being 0.05 lakhs. We have posted all these items already. Already we have incorporated all these values. Rest of the things are going to be now incorporated. Okay. So those unticked, these are already adjusted in the asset account. All these things are already adjusted in the asset account, concern asset account. We have adjusted all these things. Clear. 10 rupees equity share will disappear. Instead of that, we get 5 rupees equity shares, 25 lakhs. Another 0.6, 25 lakhs, 60,000. Am I right? Okay, you cancel this. This becomes 25 lakhs, 60,000. 25 lakhs, 60,000. I score out this one because I'm getting from there only. Okay. Similarly, preference shares totally cancel. Instead of that, we issue new preference shares for rupees 10 lakhs. This becomes 10%. The value being only 10 lakhs. These two are cancelled. You know that schedule number 1 becomes 0. And then we have, what are the unticked item? First debenture, second debentures are cancelled. Not only that, interest on such debenture also cancelled. All the 3 cancelled. This becomes 0. This becomes 0. This becomes 0. Schedule number 2 is also now 0. Schedule number 1 also now 0. Let's go for the current liabilities. Here, creditors 3.25 is going to be cancelled. 3.25 is going to be cancelled. If we cancel 3.25, now you have only 1.75 lakhs. Have incorporated. And a new 12% debenture is issued. New 12% debentures. Then here it is 12% debentures. This value being 11.1 lakh. 11.1 lakh. I thought this is cancelled, but we found that there is a balance of 11.1 due to the new issue. So Non-current liabilities has a balance of 11.1 lakh. 11.1 lakh. The next one being director's loan fully cancelled. So director's loan becomes 0. Bank overdraft was already taken. That bank overdraft now becomes a balance of bank. And then provision for taxation fully debited means now it becomes 0. We have paid it. So all the journal entry got ticked, including patent also. Then you can tally this. Schedule 1 0, schedule 2 11.1, schedule number 3, where this 0.4 will come here. 0.4. Now tell me the total of schedule number 3. 2.15 lakhs, am I right? 2.15 lakhs. Schedule number 3. 2.15 lakhs. Oh, there is no balance sheet in the text, right? Yeah, 2.15 lakhs. 2.15 lakhs. And get the total of assets, fixed assets and current assets total. Current assets total being 10.05 lakhs. Current assets being 10.05 lakhs. Now, get me the total of fixed assets. 28 plus 4, 32, 33, 37, 38.8 lakhs. 38.8 lakhs. Here, 38.8 lakhs. Cross verify. 48.85 will be the answer in the asset side. You get tallied in the liability side also. So I passed the journal entry here or there, and then I just made all the entries grouped in this page, and from there I prepared CR and bank. From this journal entry, I cross verified whether all the equivalent assets and liabilities account got eliminated or included. Then I prepared the balance sheet, got tallied. The total being 48.85 lakhs. Yes, make note of it. Now, we'll deal with share surrender method. Under share surrender method, what point you have to understand? Let's see. XYZ and Co. Equity shareholders of this company may hold around 100 shares. They may hold 100 shares. Out of that 100 shares, equity shareholders will surrender around 90 shares to XYZ company without any consideration. Okay, XYZ company can simply cancel that surrendered share. Cancel the surrender share. Okay. Or it can be used for settling some other liability. Point to be noted, on surrender, you temporarily create an account called share surrender account. You keep all the shares you receive in the capital share surrender account. Further, the journal entry being equity share capital account debit to share surrender. That's how you can replace. Later on, the shares not required can be simply cancelled. Can cancel. At the time of cancelling, your liability will go down, no? So this will be then your capital reduction. So the entry being share surrender account debit to capital reduction. This value being 90. Clear? This value being 90. Any doubts here? What happens if the shares are directly surrendered or cancelled in the very beginning? Equity share capital to capital reduction. You'll get that same entry if you are clubbing these two. Shares under will be cancelled. Equity share capital to capital reduction. Surrender share is not immediately cancelled, then we'll keep that share surrender in some temporary account called share surrender account. So equity share capital to share surrender. Later on, cancelling, no more required, you are just tear off and cancel. By the time it's your gain, share surrender to capital reduction. Now, used means that surrender share later on may be offered to somebody else. One of the creditors, used means C, one of the creditors, he says, sir, you have to pay me 100. You have to pay me 100. As I came to know that your business is supposed to be closed or weaker, settle my due immediately. Then I'll negotiate with him. I don't have the money. I do one offer. I have 90 rupees share received from my shareholders. You can take this. So now that surrender share can be given to creditors. This is called usage. Usage of this. During the usage, once a share surrendered is transferred to somebody else, the journal entry being share surrender account debit to equity share capital. To equity share capital. The value being 90. The value being 90. C, XYZ, equity shareholders, creditors. Okay. Equity shareholders gives their shares to creditors. Will it affect to the company? No. This is third party transaction. My shareholder settles to my creditors. Will not be a matter. But what is the matter? The creditors will not come to me for collection hereafter. Automatically, that creditors become zero is my revenue. Is my revenue. So this one is not a problem for me. But once the payment is made by my creditors, by my equity shareholders to the creditors, hereafter my responsibility to pay to creditors is decreasing. Otherwise, I no need to pay to the creditors. If I'm not required to pay to the creditors, it's a gain. It's a gain. So then, creditors account debit to capital reduction. 100, 100. You have to pass two entries. Okay. This is under these two entries not required. These two entries not required. Why? Equity shareholders pay hands over their shares to the creditors. For the company, it remains equity share capital only. Because of those arrangements, my liability to the creditors will go down. That's capital reduction. Anyhow, this is rather than done by the equity share capital to the creditors, it is routed through the company. As it is routed through the company, on receiving that shares from the equity shareholders named as share surrender temporarily, the moment the share surrender share is used for settlement sum of the due, again the entry is reversed. Equity share capital again credited, share surrender is debited. It means the share is simply transferred from shareholders to third party. Because of such transfer, the creditors will now sacrifice or waive their own debt. That's my gain. Understand? Share surrender, one entry is there. Okay, where equity share capital is cancelled, so it is debited. New account comes share surrender. Thereafter, I no need to consider that shares at all. We just tear off and cancel the share, then it's my gain immediately. Share surrender to capital reduction. Rather than that, if it is given to somebody else, it's none of my business. That share goes directly to them. So further, the entry being again equity share capital comes to the credit share surrender account debit to equity share capital. Because of this transaction, if that party creditors or debenture holders whoever it may be waiving some debt, then it's my gain goes to the capital reduction. C. Step number 1. Equity share capital surrendered. Number 1. Surrendered without usage, we simply tear off or cancel, then it's my gain by the time only. This is second entry. Option A. Rather than that share is handed over to somebody else, then the surrender share becomes shares. This is the option B. In case of option B, while handing over the surrender share to third party, again it remains shares only. Rather than it is held by the shareholder, it is now held by some other new parties. That's all. But because of the reason that other party waives some debt, then it is my gain. For that, you have to pass a entry here. Reduction of the liabilities to capital reduction. So the usage will have two journal entry, cancellation will have only one entry. Is that okay? This is the predominant point you have to understand with respect to this illustration. Right. Question number 7 is all about surrender of shares. The business of Rundown Limited was being carried on continuously losses. The following are the extracts. Everything is given. So 4 notes to accounts are also be given here. Almost we have 12 adjustments. We'll start with one after one. Dividends and cumulative preference shares are in arrear for 3 years. The following scheme of reconstruction has been agreed upon and duly approved by court. Equity shares to be converted into 1.5 lakhs, 2 rupees equity shares. So what happens here? 30,000 shares, 10 rupees is converted into 2 rupees shares of 1.5 lakhs. By the time also the value is same. Okay, it's only stock split. 10 rupees equity share capital account debit to 2 rupees equity share capital. The value remains 3 lakhs. The value remains 3 lakhs. Equity shareholders surrendered to the company 90% of the shares of their holding. The moment their certificate is surrendered to the company, it will be temporarily kept in a new account because we have not cancelled the shares or we have not issued to somebody else. It is now available. Okay, so then the entry being 2 rupees equity share capital account debit to share surrender account. 90% is 2,70,000. 2,70,000. And preference shareholders agreed to forego their rights to arrears of dividends, in consideration of which 8% preference shares converted into 9% preference shares. So this dividend is going to be wiped off. Instead of that, they will be now accepting a new preference shares at the rate of 9%. Of course, there is no any gain. They have only forgone the arrears of dividend. We have not considered this being outstanding. So now what happens? 2 lakhs. 8% becomes 9%. Rest will be the same. 8% preference share is going to be cancelled. Instead of that, 9% preference share capital emerges. This value being 2 lakhs. Sundry creditors agreed to reduce their claim by 1/5 in consideration of their getting shares of 35,000 out of the surrendered shares. So now we are using the surrender share. Okay, how much they are waiving? 1/5. 60,000 waiver will be there. The waiver is gain, that will be separately handled. If you are using the surrender shares to give something to the creditors, a new entry will be passed, which is nothing but again surrender share is cancelled, equity share capital will come. 2 entries. So creditors account debit to capital reduction 60. Don't forget to pass the entry for offering surrender shares. Surrender shares account debit. Surrender shares, okay. Share surrender account debit to equity share capital. 2 rupees equity share capital. This value being 35,000. 35,000. Is that clear? This scenario. On surrender, this one is okay. On using, when the shares are used, this will reduce the liability now. To the extent of reduction of liability, we'll consider the transfer of liabilities to capital reduction. To the extent of shares given to those lender, the entry being just a reversal of this entry. Reversal of this entry. Share surrendered to equity share capital. Directors agreed to forego the amounts due on account of unsecured loan and directors' remuneration. So directors forego their entire dues. Outstanding liability includes directors' remuneration as well as directors' loan. Okay. Directors agree to forego the amounts due on account of unsecured loan and directors' remuneration. Unsecured loan. Here is this 50,000, this 20,000, both are going to be cancelled. Okay. Directors' loan 50. Outstanding liability falls in the means director remuneration included in the outstanding expenses also be cancelled. This one is 50,000. This one is 20,000. On cancelling these two, we gained 70,000 rupees. Surrendered shares not otherwise utilized to be cancelled. Now, what happened? This scenario, option 1 scenario. When the shares surrendered not required hereafter could be cancelled. While cancelling, the share surrender becomes equity, means capital reduction. Okay. Clubbing these two will be the final entry. Here, share surrender account debit to capital reduction. How much is this? Out of 270, we used 35 for the settlement of creditors. Balance still we have 235 not required, can be transferred over to the capital reduction account. Capital reduction account. Now assets to be reduced as under. Assets. I'll go here. Yeah. So what happens? Goodwill is cancelled. Goodwill assets to be reduced by as under. Capital reduction account debit to goodwill. 50,000 reduced. Probably goodwill may appear here. Yes. This becomes 0. This becomes 0. Tools 8,000. Earlier we have the value for tools being 10, becomes 8 now. Sorry, 2,000 rupees. As already told you, the earlier class, I think, to confuse you, assets to be reduced by. Reduced by means to this extent value is going to be reduced. It's not 10 to 2. It's 10 minus 8, 2 will be the new value. So nicely it's confused in the exam. Stock 20,000. So 150 becomes 130. Plant 2,60,000. How much we reduced? 40,000. To debtors 15,000. 2,35,000. Is that okay? We have posted all this value. Then overall CR should be 1,33,000. So we have completed the 7th one. 8th one, any surplus after meeting the losses should be utilized in writing down the plant further. Okay, so if there is any surplus available, that surplus capital reduction can be used for writing the plant further. 9th one being expenses on reconstruction. Capital reduction account debit to bank for the expenses. The value being 10,000. Further, 50,000 equity shares were issued to the existing members for increasing the working capital. The issue was fully subscribed. Bank account debit to equity share capital. I am issuing the equity shares. The new share having denomination of only 2 rupees, so 2 rupees equity shares are issued. Value being 1 lakh. 50,000 new shares issued. Per equity share currently has a face value of rupees 2. not the original one. 10 rupees is not so. Authorized capital will be suitably increased or modified. We will do that later on. A member holding 100 equity shares opposed to the scheme and his shares were taken over by the director in payment of 1,000 as fixed by the court. The 12th is not a part of your question, not required, because it's outside the company's purview. One of the equity shareholders is not accepting this proposal. One of the directors personally pays up that. So what's the botheration with the company? The same happens to the share surrender, the similar case. The 12th is to confuse you. Nowhere each company is responsible. One equity share is dissatisfied. One of the directors are settling out of his own pocket money. Finish off. No entry. You are required to pass journal entries for giving the effect to the above arrangements. And also you have to pass a balance sheet. So these are the two entries. These are the two entries. Now, in bank we have 35,000. You have to add another 1 lakh, 1,35,000, subtract 10,000 rupees. 1,25,000. Is there any other payment? No, no payment. So 1,25,000 is the new value. Cash remains as it is. We have not adjusted the payment here. Now, you have to write off the profit and loss as well as preliminary expenses also. Okay. Default 0, 0. Securities premium can be used. Already there is an accumulated losses. Then why do I want to use the securities premium? That can also be used. So securities premium account debit 90,000 rupees. Profit and loss cancel by crediting 2 lakhs. Loss. Preliminary expenses cancel by crediting value being 5,000. Shortage amount being 1,15,000. Adjusted routed through CR account. Securities premium, P&L account and preliminary expenses all are cancelled. All are cancelled. Clear? Those items incorporated in the adjustments, I have just given a tick mark. Apart from that, I think we have only this one. This set to be incorporated. This set to be incorporated. I'll keep this here to incorporate all these things. Equity share capital, 10 rupees equity share capital, cancel. Instead of that, we get 2 rupees equity share capital, 3 lakhs. Out of 3 lakhs, 2 lakhs 70, cancel. Then we have only 30,000 rupees worth of shares. Then another 35 new shares are again the share becomes shares. Share converted to share, then again it becomes shares. So 3 lakhs minus 270, 30 plus 35, 65 and 1 lakh. 1,65,000 will be the new value. 1,65,000. All are 2 rupees equity shares. All are 2 rupees equity shares. 82,500 shares. 8% preference shares converted into 9%. There is no change in the value, only the rate is changing. Creditors, we cancel around 60,000. 60,000 cancel. This becomes 2,40,000. And share surrender 35 cancel. Already we have 270 in the credit, 35 in the debit, 235 in the debit. So share surrender completely cancel. Director's loan completely cancel. This becomes 0. Outstanding liability cancel to this extent here. This 20 is cancelled. Now hereafter the outstanding expenses being only 50. Then we have only CR. We have to prepare CR account to finalize the illustration. So for the preparation of CR, I'll just keep all these journal entries in single page. Okay. And also you can find out if there is any balance. That balance can be used for writing of which one to write off further? Plant. Yeah, plant further. Okay. Now, capital reduction. In capital reduction, by creditors 60, here by director's loan and outstanding liability 20 and 50, 50 and 20. Okay. And share surrender 2,35,000. Here to goodwill, tools, stock, plant, debtors 1,33,000. And to bank, reconstruction expenses paid 10,000. And to write off the profit and loss and preliminary expenses 1,15,000 used. Find out if there is any balance. 3,65,000. What's the final balance you still have? 1 lakh? 1,07,000 you have. That further 1,07,000 can be used for writing off plant further. Plant further. Okay. So, plant should be now reduced. Capital reduction account debit to plant further by 1,07,000. CR is recorded for the plant. I have to subtract from the plant. Another 1,40,000. Sorry, 1,07,000 should be subtracted. What is the new value here? 1,07,000. Earlier 40. Both should be subtracted. 1,47,000 should be subtracted. Then 1,53,000. Am I right? The new plant value should be 1,53,000. Right. Schedule number 1, 0. Schedule number 2, 2,90,000. Schedule number 3, 1,55,000. Schedule number 4. Come on, tell me. So 1, this is 2 lakhs. This becomes 0. This becomes 0. Schedule number 2, 2,90,000. And schedule number 3, 155. Come on, the last one. Last one. Yes, the total of the current assets. 5 lakhs. Okay. So schedule number 4, 5 lakhs. Find out the balance sheet total. I hope it is 6,55,000. Is it tallying? 6,55,000.